Mohamed, we spoke with Roger Ferguson earlier this morning, and of course, in his many roles, he was also the former vice chair of the Federal Reserve, and just asked him about how the Fed's going to be looking at the market declines at this point. If you're an investor and you're in the NASDAQ and you're down by almost 24% from the highs, this does not feel orderly. But from the Fed's perspective, this is still orderly. They're able to have a liquid market. These are not technical issues that are hammering things that might raise their concerns. Do you think that there's any chance they would slow the rate hikes, or they look at this and say, that's okay, this is expected, and inflation is our bigger issue that we have to tackle right now, not a big sell-off in the market?
So I think orderly means different things in different parts. For the market, orderly means, are my stocks going up? For the Fed, orderly means, as you mentioned, market functioning. And so far, on the whole, market functioning has been okay. I say on the whole because those of us who look very closely at how the Treasury market operates have noted outsized moves on almost no news. So there are pockets of liquidity stress, but they're small pockets. So as long as they remain small, the Fed is not going to worry about asset prices as much as it's going to worry about controlling inflation. And they need to regain credibility. That credibility is very low right now.
How much of the moves that you're seeing that concern you in the Treasury market could just be related to the idea that the Fed has been the biggest buyer in the Treasury market and they're backing off because there's no more quantitative easing? They're not going to be the big support in that market.
And that's a really important point. I think the market has understood and priced in the rate hikes. In fact, I think the market has gone too far in pricing in the rate hikes. I don't think the Fed will be able to hike rates as much as what's priced in. But what the market hasn't quite realized yet is the QT element, is the balance sheet reduction. Just to give you a sense of what's ahead of us. Last year, globally, we expanded the balance sheets of central banks by over $2 trillion last year. This year, we might reduce them, I suspect, by about $0.5 trillion. That's a 2.5+ trillion turnaround. That is really significant. So keep an eye out on the QT element, and that's where the Fed could surprise us this week in terms of what it says about QT.
Meaning that they're going to say, I mean, they've surprised us before and said that they were going to start tightening more quickly than the market thought. You expect to hear more in that vein?
So they have to regain control of the narrative. They have lost control of the narrative in a meaningful way, not just the inflation narrative, but the policy response narrative. And that's why the market has run away from them. And every time they've tried to catch up from the market has run further. So they've got to regain credibility. It involves two things. One, like what the ECB did last week, explain to us why you missed your inflation forecast so badly. And then the second thing is give us some guidance on the QT. How much per month? Starting when? I suspect it will start in June. I suspect they'll tell us maybe 50 billion, maybe up to 70 billion, but the market will want the pathway, and it's not clear to me that the Fed will supply that at this meeting.
Shepard Smith here. Thanks for watching CNBC on YouTube.